What structure should you buy your next property in? Hi, I'm Sam Powell.
And I'm Jared Krause, and we are the hosts of the Property Pals Australia podcast. And in this episode, we're talking with Andy Giobbi from Binary FinTech Group, who is not only an accountant, but also a financial planner and a mortgage broker. Aside from how smart this guy is, he's also one of our good mates who likes to kick our butts in tennis, whilst we definitely have it over him in the surf. He's helped many of our friends and family as well to buy incredible properties and save coin on tax whilst doing so. And in this podcast episode, all three of us talk about the pros and cons of buying properties in trusts.
Yeah, and we also balance it off with looking at the pros and the cons in buying in your personal name, because it's really important to marry those two together to get the right understanding of which path to go down.
Yeah, I also asked Andy how he became a finance broker, an accountant and a mortgage broker, and what that path looked like for him and why he went down that route.
Yeah, as well as we do touch on what structures you should typically run when you're starting to build your property portfolio. And much more. So it's a really insightful episode that we hope you get a lot out of. But before we do get stuck into this episode, I did want to tell you that this podcast is not the only way that we do help people for free. We have our How to Maximize Your Borrowing Capacity mini course on our website. So please head on over to propertypals.au/resources and use this tool to buy a superior asset and achieve a better return on investment. See you on the inside.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. All right, here we go. The lads sitting down, having a chat around property and structuring. Yeah. Thanks for coming on, Andy.
No, not a problem at all. Thanks for having me, guys.
It's been a long time coming. We've chatted about you a lot on the pod. And we've been seeding this for ages. I guess we should probably start with like something a bit more casual. How did I even meet you, Andy? And when did you meet Sam? When did you meet Andy? Like, I think I met you obviously through Joel, a friend of ours that Sam and I went to school with. But it would have been, of looking at photos, it would have been before 2018.
Yeah, it's been a while. He was definitely the connector.
Yeah.
And I think he is one on the Gold Coast for sure.
Yeah. What about you, Sam? You got a funny Andy story?
Yeah. Oh, they're all funny. I was on the hunt for a good accountant at the time, and then finding out that Andy wears the accountant, financial planning, and mortgage broking hat was a rare find in the industry. And I've had a lot of sage advice from Andy, which I've been able to share as well through my knowledge and experience with clients. So I think
you're probably just trying to get free advice was what you're going for.
I had to buy you a beer once every day.
I'm still waiting for that.
Yeah, I'll come into your office actually, because you have
No, I think the best thing for you and me, Pally, was I did your first tax return and then sent you the bill. I don't know, maybe you weren't too happy with the bill, and I said, that's fine. I'll play you one-on-one in basketball. If I win, you got to pay twice as much, and if you win, it's free.
Yeah, well, I don't know. I didn't think you'd be as good as I.
So did he pay twice as much? Did he?
No.
He didn't want to play. He didn't want to take it to the court. He just settled the invoice and off we went.
It's just a typical me, is I'm always asking for a discount, and Andy knows his worth. So, you don't ask, you don't get. And he challenged me, and I thought, look, I know he's looking after me, so I'll just put the brakes on it. I don't have time, mate. I've got 2 kids.
You've got height and skill over me, so you would have won that, but I was just bluffing.
I love it. That's a good story.
We'll film that one next, but I don't want to get too off
Yeah.
topic. Let's jump
We'll
into some accounting questions.
We're supposed to be talking about structuring. We could just chat all day about funny crap, but let's dive straight into structuring. When should one buy a property in their personal name versus, say, in a different structure like a trust?
Yeah. So the first thing we always chat about with clients is just trying to get an idea of what their plan is long term. A lot of people sort of come in and they don't really have a plan of what they want to do, or they haven't really looked at what the next few years are going to look like. So usually that comes into play quite a lot, depending if they want to build a portfolio out, what sort of properties are going into that portfolio, how many they're kind of looking at actually putting in there as well, or if they sort of just want to buy one property and that's it. Even coming down to things like, I had a meeting with a client this morning actually just discussing this exact thing. What's happening over the next few years with your relationship? Where's that at? What are the next steps there? You're looking at kids. Is work going to be changing? Some people like to sort of just, especially now with the side hustle culture, a lot of people like to sort of just start businesses here and there, not actually thinking about the potential implications this might have on them with finance. So it always comes down to just like asking as many questions as you can up front, just finding out exactly what's going on, and then really getting an idea of what they're trying to achieve. And then sometimes that guides you with what structure would be best. You also get people who just come in, there maybe a few of them investing together, got a bit of money there and a bit of a backing, and just want to have things done in certain ways. But for most people, it just comes down to, a bit of planning as to what they're trying to achieve, and that kind of guides that structure talk.
Yeah, so the idea in mind of having a strat, like knowing what your property portfolio is going to look like in 5 or 10 years of what your goal is, then that's going to allow you to know like what your property portfolio is going to look like, and then how to structure from day dot, right? So for somebody, just as an example, somebody has 80, 90K wage, they're going to buy their first property, it's around 500K, and they have a goal of getting to 100K passive income in property, and they want to do it through a couple of residentials, maybe 3 to 4 residentials, and maybe a commercial or two down the line. Like, where would they start? Would they just, because I know what I did for myself is like, I just went up and was like, I just want to buy as many properties as I can, and I don't want them against my personal name. So I just did my first acquisition in a trust, which I probably wouldn't suggest. And then I bought my second one in a personal name. So what's the regular route, and why would that? Yeah.
And this is the thing that's always annoying, especially with these questions, is it always depends. And that always seems to be the answer to begin with. It's like, well, it depends. The thing here is it always depends on how much money and things you need at the start as well. So if you were going to buy your first investment property, and it was going to be, really negatively geared, you put that into a trust, and essentially you're not getting the benefits of that negative gearing. If you need to use that money at the start to help grow and help build things and get a bigger refund, and maybe that's part of your overall tax strategy or something you've sat down and worked out, then putting it in a trust is obviously going to stop that straight away. And then there's the other side of the coin is when you're looking at properties like commercial properties, they're usually very, very, very cash flow positive. So that's something that maybe you want to put into a trust so you can get the tax benefits of distributing that with a bit of flexibility, or the income that generates.
Yeah.
So
awesome.
a few different scenarios there, but it always just depends on that person's situation. Maybe they've got a lot of money up front that they're happy to kick towards it, or maybe just based off the rent or whatever they're doing with it. If it's a short-term rental, maybe they've got more income coming out of it, and it is positive straight away, and they can prove that pretty easily. Then maybe putting it in a trust is good if they've got a partner who maybe is on maternity leave or not earning as much, and you can sort of take some of those advantages there as well.
When would the case be to actually purchase a commercial or a high income under your personal name? Was that uncommon?
I don't see it too much, to be honest. Usually it's put into a trust. So I'm not too sure of any reasons why you'd want to actually have it personally in your name. The other big benefit of a trust is definitely around asset protection. So anything that happens to you, just say you and your partner both hold this property in a trust, someone works in an area that's highly litigious, they're obviously more at risk of being sued, or if they've got bigger debts elsewhere, maybe creditors come after them. You're protecting yourself, keeping that asset locked away in another entity, and then you've got a bit of protection there if something ever happens to one of the partners.
Well, that goes into your situation, Jared. Obviously, you're a business owner, so you've got that risk there. And was that your mindset initially?
Yeah. Well, my mindset was like, and from what I heard is that if I want to scale my property portfolio and I want to buy multiple properties, what holds people back is, borrowing capacity. And if I get multiple properties in my personal name, then, that can hold me back because the banks will be like, look, you've got all these properties and you've got this much debt. Like, we might not be able to give you as much borrowing anymore. So I was just like, set myself up to just max borrow. And I'm glad I did do it that way though, because the first property I bought for $400K and we were getting rent straight off the gate for $570 a week. So it was positive, right? So, and then the second property is negatively geared just because due to the economics of like the interest rates at the time, and put that in my personal name, which is actually going to be quite good for my next tax round.
Yeah. And this is where it comes back to loan structuring as well, in the sense of, interest only versus principal and interest. Being able to get something that maybe is negatively geared when it's P&I, but is positively geared when it's interest only. And, being able to piggyback off that to help grow your servicing is something that we look at as well.
So that, talking about that situation of buying in your personal name, when does it become a tricky thing to acquire more properties in your portfolio if you do have too many in your personal name or too much debt in your personal name?
It's always going to come back to servicing for the banks.
Yeah.
Their biggest thing is a lot of them don't really look too much at what your asset holding is. You could have $1 million in the bank, want to buy a property with a $500,000 loan. You could easily pay that, but if you're servicing and you're not actually earning enough income there, the bank's not going to lend you that money. It doesn't matter what assets are sitting there against your name. It's all about servicing.
Does that account for personal name and/or trust structures?
Yeah, so they'll look at you as a total group. So if you're trying to borrow and you're down, so usually when you get a loan through a trust, depending on the bank and depending on the structure of the trust, they can take personal guarantees from either the beneficiaries or the directors if it's a trustee company that's acting as the trustee. Sorry.
Yeah.
So if you've got these personal guarantees on these loans in the trust, and they're still going to look at you as a total group and be like, well, hold on, you've got debts over here in the trust. You got income coming from that as well as all the stuff you've got personally. So it's always a group.
Is it whereas like if I'm going for finance for another property, say I'm going to buy like I've got one in my personal name and I've got one in a trust and I'm going to buy another property. If I buy that, whether it's in a trust or not, doesn't really matter. But when I go for lending, will the bank, I can hide that trust, or I can that trust that I have for the first property, they're not going to use that against my serviceability, right? Because I don't have a personal guarantee against that. Yeah,
if you don't have a personal guarantee for that loan, then that liability won't be counted against you.
So that helps people borrow more, right?
What was that, Fowler?
How do you structure that? Just for listeners, it's sort of like a key point.
You can have just the main family, like a main family member as the beneficiary, or maybe as a director on the trustee company, or as a trustee themselves. We always prefer to have a trustee company in place for a trust. Just there's a few different rulings and things you can get around stamp duty and stuff like that, but I can go into that a bit later. But yeah, it's always if you've got someone who you definitely trust, like a spouse, obviously, or a wife or whatever, and they're the primary beneficiary and the director, on the trustee company, then obviously that will be attributed against them.
Yeah, tell us about the tell us about the difference, trustees, difference in trustees, and why you would choose one over the other. Like, I know that I've just got a discretionary trust and a company that's the corporate trustee of the trust. I presume that's pretty stock standard.
Yeah,
I guess.
So the main thing that triggers stamp duty is just a change of beneficial ownership. So when it's held in the trust, it's held on trust for those primary beneficiaries. So if you make any big amendments to the trust deed, that can actually trigger stamp duty because it will look like a change of beneficial ownership. But if you've got so just say you were an individual trustee on that trust, and it was the Jared Family Trust, and you were the main trustee for that, and then you wanted to change out and put family member or something in there, that would trigger stamp duty for that change of ownership. If you wanted to change one of the beneficiaries as well, that could potentially also trigger stamp duty.
Right.
But if you have a company as a trustee company, and you change that director, that won't trigger anything because that doesn't affect the trust deed at all. Trust deed will stay the same, still got the same company as a corporate trustee, and then you're just changing things behind the scenes there.
That's
so you can change.
Really key point for people who are listening, just to rewind and re-listen to that.
Well, you can change whoever controls that trust without having to worry about stamp duty or anything.
Because you change the director of
the director. Yeah. So a lot of this stuff, this also helps a lot with estate planning as well. So down the line, if you put a primary beneficiary as another family member, you can distribute funds to quite a lot of people related to that person, and then you've got control over changing who the director is of that, who makes those decisions as to where those funds go.
So I guess I'd like to just run through the pros and cons of a trust, and then the pros and cons of personal buying in your personal name, because I know that we've alluded to it a little bit, but like maybe we should just bullet point a few pros and cons of a trust, and then we'll move into the personal.
Yeah. Main things are the main benefits of a trust is obviously the tax benefits, so you get a bit of flexibility around where you can transfer money. Estate planning. You also get a bit of help on, you can anyway, on land tax thresholds.
Ooh, so juicy.
And then asset protection is the other one. So they're four pretty big points, to be honest. I'll go back through. So obviously asset protection, we've kind of already chatted about that a bit. With the tax benefits, if you've got money coming into that trust and it's discretionary trust, before 30 June each year, the trustee decides where that or how that money gets distributed. If it's a discretionary trust, it's completely up to their discretion. It can go to this primary beneficiary or that one, maybe 80% to this person, 20% to that person. So what generally happens is you can move that and make it tax efficient. If there's someone who's earning $180,000 and another partner who's earning $60,000, completely different tax rates, they've got the discretion to move the funds where they want.
Awesome.
So that can get a big tax win there. With land tax, this is one that's going through quite a bit of reform. I'm not too sure how much you've had to do with it, Pally, lately.
Oh, everyone buying up in Victoria, and they're the devils in the property investing world, the Victorian government. Yeah,
exactly. And we actually had a case the other day. So Victoria, correct me if I'm wrong on this. Victorian stamp duty, this is specifically for trusts, which I'm talking about, is the threshold was reduced to $50,000. And then you've got a percent on top of that. So there's actually a land tax surcharge that gets charged on top of the land tax that you're already paying.
Wow. Yeah, the personal name got dropped from 350,000 to 50,000, but I wasn't aware of the surcharge. But that makes sense because often the trust structures incur a lower land tax threshold than the personal name in most states. But that does make sense, and it's a big key reason why at the moment we're out of Victoria for those reasons. There's a lot of unknowns, and the cash flow wise, it just kills any deal that we're trying to marry up with good capital growth and cash flow.
Damn, that's crazy. And so with a trust, if you were to purchase an asset in a trust, say such as Victoria, that asset that you purchase in the trust will be separate to like mixing up land tax, like adding land tax together, right?
As in, from a personal
Yeah, from a
and a
personal to a trust, like it doesn't.
yeah. So that land tax will get charged to that entity,
Yeah.
and I think they charge it. I'm not sure if they charge it monthly or maybe quarterly, but it's
Well, quarterly from my anticipation, but it's always changing with
So
regulations in different states,
with
right?
the
They run
land
their
tax,
own
I think
state-based tax system.
Queensland has a different
That's what
land tax
land
threshold
tax
as
is,
well.
state-based, and they change between different states, WA to Queensland. So it's a fun time to keep in on top of. That's for sure.
yeah.
Cool.
I think we missed a bit of that, Pally.
Oh, might
The
have
recording should have got it
Oh, okay.
with this
Sorry.
software. So there's a benefit with those two benefits. We've been through those two benefits. What were the other two?
Estate planning, which we chatted about. So with estate planning, sorry, you can put other family members in there as primary beneficiaries. Generally, a trust can stay, open for 80 years. You can put different rules in the trust of how they operate and how you want things to go if someone passes away and what happens to those assets. So you can kind of be creative with what you want to happen to the assets that are held in the trust if you were to pass away or something was to happen. So it gives you a bit of flexibility around what happens there with avoiding taxes and things like that, as opposed to, if a property that you're holding just passes to someone else, usually they've got a couple years to do something with that property. So if my parents are holding a property, investment property, or even just their home, they pass away and it goes to me. If I don't do anything within 2 years, and I start using it as an investment property, then I'll actually have to carry on the tax implications from a CGT standpoint. You can.
Sorry, just at the end, so at that 2 year period, this is a good point to hit home because it's quite relevant to a client I'm dealing with at the moment. My interpretation was, well, that becomes essentially an investment product. If it was your grandparents or your parents' principal place of residence, so there's no capital gains tax involved.
Up until the date that it transfers.
So the date it transfers, and then you have 2 years from that transfer to sell it, or
yeah.
So you'd need to get a valuation on the date of transfer, and then that becomes the investment property. But you can hold it for an additional 2 years and sell it without having any capital gains tax.
Holding it for an additional 2 years from when you get it and you're using it as an investment, or you just mean as a home?
As a home. So your parents pass away, and then you've got that the transfer of title goes into your name. You've got 2 years to sell that asset without having to pay a capital gains tax. Is that correct?
Sorry, mate, I lost you on the end of that.
My internet connection is rubbish. I'll let you two run with this.
Well, yeah. So there are certain things that you can use to transfer assets to family to sidestep some of these rules.
Yeah. What other pros are there to trusts before we move into the cons?
Those are the four biggest ones.
Before we continue today's pod, I want to ask you a few questions. What is your property investment goal? What type of properties do you want to own? How many? What size valuation property portfolio do you want to own? And how much net income do you want to be earning? Essentially, what's your magic number in passive income that you want to be earning? And do you know how to get there? And if you do you know how to get there in the least time possible with the least amount of risk? Sam and I have been helping people invest in property and build property portfolios for years. People who are now replacing their income through property, and we want to help you do the same. Right now, for a limited time, we are offering free property coaching to our listeners.
We won't be able to do this forever, of course. So head to propertypals.au/coaching. That's propertypals.au/coaching to see how we can help you achieve your investment property goals. Link will be in the description too. And why would we? What's the negative of using a trust? Like one being this, what we've already mentioned, the negatively gearing. You can't, if you're losing money on a property because it's negatively geared, you can't put that against your personal income at tax time and decrease your personal income for tax purposes, right?
Yeah, that's correct. The trust. You can soak up future income. So, if you had a 10 grand loss over a couple of years and then all of a sudden, this starts turning a profit, that first 10,000 is going to be wiped out by that loss before you have to start distributing that money out. Similar to sort of how a company works, but yeah, you don't actually get that negative gearing benefit at the start. So that's a big one. The cost to set up and maintain, it's not too bad. If you're going to have a corporate trustee, there's things like the ongoing ASIC fees. Obviously a trust would incur another tax return and potentially financials that need to be prepared. So your accounting costs could go up as well. So they're just something to be mindful of. The other thing is at the moment, you do get the 50% CGT discount, but it's one of those things where, there's still legislative risk here with holding a trust.
So tell us about that. What do you mean you get the 50% CGT?
So holding an asset for longer than 12 months, if you go to sell it, whatever your capital gain is, you're allowed to cut that in half. So 50% discount on that capital gain as it flows down, and then whatever's left would go against your tax return and then be taxed at your marginal tax rate.
So that's when holding that property in a trust.
Yep. So you still get that discounting from a trust. You don't get that discounting in a company. So if you held a property in a company, you completely forego that discounting. So no discounting at all. So you still get that in a trust, even if you have a corporate trustee. But the thing is, as we've seen with Melbourne or Victoria and the land tax reform, CGT and stamp duty, all these things are, continuously being brought up. Even, Labor talked about negative gearing, at the last election or whenever it was. There's still risks that these things could change. Obviously, I'm guessing if it did for whatever reason, there'd probably be grandfathering for whatever properties were already in these structures to begin with. But it is always something to be mindful of that things can change.
Yeah. Yeah. Wow. All right. Any other cons to trusts?
They're the biggest ones.
Yeah.
Yep.
And I guess it's obviously nuanced depending on the person and their personal finance situation.
Another thing is complexity. Banks as well. Oh, sorry, no, this is a big one too. Now that I think about it, the actual complexity of a trust, it limits your potential lenders. So a lot of lenders don't actually really like people using trusts. So you cut down your options drastically. If you're just purchasing a trust, if you're purchasing through a trust with just yourself and your partner being the main contributors to that trust, or at least the funding of it anyway, there's a lot of banks who won't even touch that to begin with. Yeah.
So you decrease the lenders that you could possibly use
on your panel. Yeah. So maybe what I've seen, it cuts them out a lot, but it's not to say that you're not getting a good rate still anyway. But you never know. Like, you just cut down with certain lenders. Maybe they have a policy in place that doesn't actually suit something else that you've got. Maybe you're self-employed. This bank's happy to lend to you through a trust, but some ruling in their policy doesn't actually agree with what you've got in from your self-employed income. So banks look at companies if they've had a big increase in income. So let's just say 1 year you've earned 200 grand, the next year 300. Things like that kind of throw the banks off a bit, because they're like, well, hold on, is this sustainable? What's actually happened for this big increase? And that can actually put you backwards and put you in a bad spot with some of these banks.
Wow.
You do have a reduction in your options, but it's still very much doable.
That's so weird that a bank would look at that of like, oh, is this sustainable, and then decrease your borrowing capacity lower than what it may have previously been. If you've
Yeah.
got an income of 200K and it goes to 300K and you could have got borrowing capacity with the 200K income, now they're looking at your income being lesser. That's so interesting.
Yeah, well, you just don't know if people are, fraudulently inflating income for for finance and things like that. So, if you've looked at someone who's been trading and they're consistently, maybe they're growing by 5% every year for the last 5 years, and then right before they go for finance in their last financial year, it's just exploded. Obviously, there's a myriad of reasons why that could be legitimate, but it's just something that they need to investigate and draw more light on analysis on your financials.
Yeah. So then that's trust. Let's go through let's continue down the track of personal buying in your personal name.
Mm-hmm.
Like that, yeah.
Yeah. Pros. It's easy. It's easy.
Why is it easier? Why is it easier?
Because
I know why. I've been through the process, but just for people listening, like why, think about somebody that's just, listening to this and like, I want to build a property portfolio. We want to, why is it easy to buy in your personal name, maybe for your first property?
Yeah. There's less documentation and less analysis and things from the bank to begin with. If you're just a PAYG borrower, you and your partner, and you've had a good track record, your credit score is good, you tick all those boxes, all they're going to need is your identification, pay slips, bank statements, maybe a couple other little things here and there. And then that can really be it to get approval. When you start looking into trust, there's a lot more issues and things that can pop up and a lot more documentation that they need. So the process itself can be a lot more streamlined just for an individual.
Do you have a rough calculation on the difference between personal name and trust structures from an accounting point of view and what it costs to hold? Is it like $1,000 extra a year, or any idea?
To actually hold it, and
the difference between the cost of a trust and the cost of just running your own personal name.
When you say costs, you're referring to all the setup and holding costs. You're not talking about what a bank might charge differently.
Yeah, just the setup and holding.
Yeah, well, it's depending on accounting firm to accounting firm and what they've got and actually the complexity of the trust and what's going through. But if you're just needing a tax return, usually a tax return for a trust can vary between, a few hundred and potentially 1,000 at the worst, I would imagine. If it's a pretty simple trust and just getting tax returns. If you're getting financials, then it might push it up to a couple grand just for that one trust. And then ASIC fees, if it's a corporate trustee, have gone up to $310 a year now.
Okay.
So that, at worst, you'd be looking at, a couple of grand, $2.5 or a bit more. But that's ballpark figures. A lot of accounting firms charge a lot of different stuff.
No, but it's just good to know because people are sitting there going, "Oh, it's probably too expensive for me to hold the trust, so I'll just go my personal name," and they're foregoing the risk issues with your personal name. So it helps them go into the meeting with their accountant with a little bit of knowledge, and they can be more open and understand what is the best process for them.
Yeah, and there's obviously a cost involved in setting up the trust as well. We always advise people not to just go online and do a DIY company or trust setup using whatever website.
I was going to ask you about this.
Yeah. So
why not though? Because this is really good. Because a lot of people are like, I can do it for like $500 on myself online. But why not?
Couple of reasons. One thing is you could make a pretty big mistake by putting the wrong person in the wrong place. Mm-hmm. Even potentially, getting the shareholding wrong on a company. Maybe putting the wrong person as a trustee or someone as a beneficiary or other way around, or having the settler as the wrong person, or even having with trusts, if you set yourself up as the settler, the primary beneficiary, and the trustee, then that trust is essentially null and void. Like you control every single part of that process, and the ATO is not going to allow you to do anything with that trust if it came under the spotlight, that is. So there are a lot of mistakes you can make. You set up a trust incorrectly or a company incorrectly, and then you start using it. there can be pretty big tax implications down the line if you need to unwind that or make some changes. So it's always good to sort of sit down. We usually just send them a questionnaire. This is what we're going to do. Who do you want in this position, this position, this position? Explain what each of them are, how they all work, what the roles and responsibilities are of each, and then really get a good understanding of who's going to be in what position and why, and then really, educate the client on what that all means and what their obligations are as well.
Yeah, awesome. Now, is somebody coming to you with 90, 80 to 100K wage, and they're like, I want to build a property portfolio, and they want to buy their first property. Maybe their borrowing capacity is, they want to buy something for around 500K or something for their first property. But they do want to get it to that stage where they've got a few properties and they're getting 100K passive income, down the line. What would you typically suggest them to do in terms of starting with structuring? Would you suggest buying first in their personal name? And this is very general. This is very general, right? It's obviously going to be very different and dependent on a few different things for different people. But would you generally recommend somebody to start by 1 or 2 in their personal name first, or what would you suggest differently?
Yeah, generally speaking, if it's going to be residential property, and they're borrowing 80% or maybe 90%, LVR, then it's, usually best to put it in their personal name, especially if their income's around that, 80, 90, 100 grand. They're going to need every dollar that they've got coming in. You never know what's going to happen. I'm sure Sam has seen this a lot too. You never know what's going to happen to the property, other costs and things that pop up. So if you're trapping all those potential negative gearing and all that stuff that can contribute to a bigger refund and help with cash flow, you're better off kind of doing that in your personal name, especially at the start, with residential to help you build that up. The big thing we look at is just the structuring of the loan in the sense of interest only, to try help them get cash flow, because obviously cash is king, especially early on in the investment journey. So you want to make sure you're sort of freeing up as much as you can and you're not sort of tripping over anything to begin with.
Yeah, awesome. And would you recommend people to buy more than one in their personal name before they start moving into a trust? Say they want to get to 4 residential properties and then buy a commercial over a few years. What would the next step be for somebody? As I know it's very general, but in terms of structuring from then for their second and third property?
It's always going to be case by case for all of this, depending on what's going on, what's happening in the family dynamic. You might have one in your name already, and then you're looking at getting a second property, but the partner's reducing their income greatly. There may be reasons for putting it in a trust there. The thing is, whatever structure you choose to go with at the start, more or less will be the one you stick with for a very long time. Because, if it's in your personal name to begin with, you can't then move them into trust later without incurring stamp duty. So we'd look at what's going on. So your second, looking at second and third properties, we'd be looking at, how much equity have we got there? What all the servicing is going to look like, what potential rental income is going to look like, and generally get a good idea of how we're actually going to structure these loans to get you good cash flow.
Sam, you're gonna ask something? He's frozen.
I got a common question that comes through in my line of work is, we want to buy a property, we've got the cash, we don't know whether to go personal name or to buy into a trust. What should we do? And my overarching advice, which most people will probably pick up from this conversation, is step 1 is always speak with your accountant and then your mortgage broker. They're the best people to give you that sage advice. And you'll go in, you'll have these questions that Andy's obviously pointing out, and that's really going to help you make those smart decisions that's going to set you up for your long-term success. That's my little 2 cents.
No, and you're completely right there. It is, a lot of this is definitely guided purely on where they're at and what each situation is for each person. Someone who's getting a pretty big tax bill every year, if you're going to start adding more or not giving them the benefit of using that negative gearing, to help them with cash flow, then it's just going to become worse and worse, because maybe they're holding an asset that they've got to contribute more money to, and they're not getting any real benefit besides, that capital growth.
Yeah, no benefit in terms of cash flow.
Yeah, and this is where it's handy for us, especially myself and another partner that I've got here, is the fact that that we are accountants, and we started as accountants and then have moved into the property space.
Sam actually wrote down a question to ask you around that, and that was like, does having a background as an accountant and a financial planner help to give you a competitive advantage as a finance broker or a mortgage broker? And it sounds like it definitely does.
Yeah, it absolutely does, because and I'm not too sure how I don't want to throw anyone under the bus or anything, but the rules are, as a mortgage broker, generally you're not allowed to talk about tax. Same way accountants can't talk about investments and super, and a financial planner couldn't talk about loans, for example.
Legally.
Everyone's legally, yeah. Everyone, yeah, exactly, legally. Right, yeah. So, yeah,
just like me on this podcast, I can't give any legal advice here.
Yeah. So there's legislation saying what different professions can and can't talk about. For us, being an accounting firm and licensed with our own AFSL for financial planning and everything else, and just from my own professional experience and upbringing, I look at someone's position, and the financial planning side of me just starts firing off with more questions like, what are you planning on doing with this? What are you doing with that? What happens if this occurs or that? And you kind of just come up with different strategies. They're asking a lot of questions to really dig down into that person's situation, what they're thinking and what they want to do. Then we got the accounting side, where we're kind of looking at the structuring and the planning of, all right, these are the different structures that we have available. These are the tax implications of each, which one's going to put you and set you up as best you can. And then obviously on the mortgage broking side, we're able to sort of chat with all the banks and compare lenders and do all the structuring on that side. So it does all fit in pretty well.
Yeah.
And then really, if you went and saw a normal broker, they're only really allowed to talk to you about the loans and the structuring of the loan.
Yeah.
And, they couldn't really give you any tax advice and things like that. Legally.
Structuring advice on set your trust up this way, and
you can still talk generally about things, but as soon as you start diving in and asking questions, that kind of triggers rules around what's personal advice.
Yeah, I have spoken to finance brokers where I've said what should I do with what entity should I purchase in, stuff like that, and they some will allude to certain ideas, and then some will just be straight up like, look, you're just going to have to speak to your accountant about it. So
yeah, and I see that all the time. People come and they say, oh, my accountant or my whatever said to do this, and it's like, well, no, that's that's wrong. That's wrong because of this and this. It doesn't happen all the time, and obviously there are a lot of good brokers out there. But the other thing for us is, coming from the accounting and financial planning background, it's all about just building long-term relationships. So we don't want to just be transactional. There's a lot of brokers out there still in the space that it's just transactions. It's all about volume, getting people in, getting the loan done, see you later. There's no back-end service. For us, it's just, getting in, building trust with someone, getting an understanding of their situation, what they want to achieve next, and then you kind of you go from there, and you end up having them for a long time.
Yeah.
And we've got clients that I've known since I very first started as an accountant, who are still around now with us. So
yeah, it's the best way to go, because they're winning and you're winning long term, versus just churn and burn approach in business is just crazy. There's so much effort for little reward.
Yeah. And that, it kind of cuts both ways too, because sometimes we're a bit selective with the clients that we do work with. Especially from, a lot of all these cashback offers and things that were going on from banks. You do kind of get the usual, tire kicker who comes in, asks a few questions, trying to get some loan advice around stuff. Maybe they do end up getting a loan for them or refinancing. 6 months later, they refinance somewhere else, and they're just chasing these cashback rewards and things like that from banks. So, you've got to be a bit selective around that.
This is a key reason why it took me years to find somebody like Andy, and why we wanted to bring him on is just having someone like that and not blowing smoke up your backside, mate. But the three hats that you wear, I mean, it's a game changer, and I just wanted to, I guess, let people know that just through this conversation, obviously seeing why you're a close business associate of ours as well, and you're obviously my accountant, and it's just great to have that knowledge source in my back pocket.
Oh, same with you, mate. That's why I pester you all the time now.
That's why we're getting you on, Andy. This podcast is used to just get free advice on tax, financial planning,
general.
Yeah. Well, and that's the biggest thing here is education. The clients who come in and you want them to ask as many questions as they can. You want them to leave having a good understanding of what's going on. Obviously, you can't learn everything straight away or, from a 1 hour meeting. But it's just that continual education for the client so that they're comfortable with what they're doing, what the next steps are going to be and why. And then, they feel good leaving, you feel good that you've helped someone. And that education part is huge because a lot of people just don't really know enough about all this stuff.
Well, yes. How are they meant to, right? Like you learnt your knowledge through university, going to courses outside of the standard education system, and that's the issue with Australia's education system is that it's set up for people to fail because they don't know any better.
Yeah. Well, the thing that really shocked me, I remember doing this when I was at uni because I ended up, similar to Jared, I started off as a tradie in my career path.
Actually, I was going to ask you, tell us your progression of career so people can see where you went from and how, there's different phases of financial planning into accounting and mortgage broking, just so we can, I don't even know, to be honest. I knew you were trading, but, I'd like to hear, yeah.
Oh, man, my story's got a bit of a naivety in there as well. So I left high school and went on to be a tradie. I'm originally from Adelaide. I came from a family of tradies as well, so everyone had a different trade under their belt. So I, out of uni, became a electrician working on high voltage and low voltage distribution systems, which is a fancy way of just saying power lines. And then and then did that, was qualified, and then moved to the Gold Coast. And then couldn't handle the weather here.
As a tradie.
Yeah, as a tradie, because there's no humidity in SA. So couldn't handle that. And then, the companies were a bit different here. I think maybe I was just a bit too looked after in the company I was with back in South Australia. So through trade school, you do a lot of maths. So anyone who's, electrician, you're doing a lot of trigonometry and transposition and all this other stuff. So I became pretty good with maths. So I thought, oh, I can't keep doing this forever. I'm not going to survive in the Queensland weather doing this. And I had the opportunity, so I started studying while I was working. So the business school, ran a lot of courses at night. So I was just working during the day, then going to uni after that. Thinking, my thought process was, well, I'm really good with numbers and I like numbers, so I'm going to go study a commerce degree and just learn about, accounting and finance and all that sort of stuff. Didn't realize that it didn't really have much to do with numbers. As much as people think accounting is just number crunches, it's not really much maths involved with accounting. It's more legislation and understanding what you do with money and why and tax law and things like that. So that's kind of how I fell started that transition. When I was studying as well, working full time and then studying at night only lasted so long because that was just a bit too much to take on. Be working, from 6 a.m. till 4 p.m. and then, have a quick shower, then go to uni till 9 or 10 o'clock at night. That had an expiration date on it.
Sure.
So then in my first year, I said, oh, stuff this. I'm just going to go actually see what it's like to work in an accounting firm. So I just went around I just Googled all the accounting firms that were around in my area, and then just walked in with a resume and just said, hey, can I just chat to whoever's in charge here? And then just try to give them resumes. And off of that, I think I went to maybe 10 places and got I think 3 job offers on the one day. But I said to them, I'm just started studying. I'm in my first year of uni. I just want to get some experience in the industry. I'm happy to do a day or two for free just so I can see what it's like. I'm never going to work for free. Like if any of them had actually said yes, like, oh, you're more than welcome to come here and help with filing and whatever else 1 day a week for free, I'll probably would have come up with a nice way to reject that. But then off the back of that, they offered, proper paying roles. So one of the guys who offered me a job, who's actually my business partner to this day now, he was running a multidisciplinary firm. So he was doing accounting, mortgage broking, and financial planning. And he was sort of overseeing all of it, but had people underneath him in each of those disciplines. So then I was just there in like an admin support role. So I was sort of getting exposure to, all three of these different disciplines. And then as time went by, I gravitated more to sort of financial planning, and then a bit to accounting. And then he ended up selling the practice. So then I went to, and Powley's going to love this one. And then I ended up going to AMP for a little bit. So he sold his book to AMP.
Yeah.
And this was not too long after the time that they had actually legislated, or abolished, commissions and all these other things for investment advice in the financial planning industry.
Planners, like commissions for financial planners.
Yeah. What was that, sorry?
Around the Royal Commission?
I can't remember which one it was, but it was when the whole Storm financial thing happened?
I thought that was
Was that 2011, 2012 or something maybe?
Yeah, because I was a financial planner with one of the big four around that time, and I ended up leaving the industry just because of the high levels of regulation. And you kept pursuing on, mate. I went back into property.
So I saw what was happening there, and there was a lot of dodgy stuff going on that no one was sort of even blinking an eye at. And it kind of got a bit disillusioned with the whole financial planning industry.
Mm.
And then that's when I moved and took a bigger step, resigned from there and went to a firm in Broadbeach and was working there for a little bit. Before
as a financial planner?
No, as an accountant.
Yeah. Okay.
Yeah. Because I had enough knowledge in the accounting space as well to go there and just work as an accountant with another firm. And then after doing that for a little bit, I reached back out to my old business partner because we'd stayed in contact through everything, because he was sort of my mentor as well. And then said, all right, cool. I'm ready to start my own business. If you're happy to help me out and do whatever. And they were more than happy to help. And then we sort of started growing the business from scratch back up. A lot of old clients sort of started trickling back in, and then kind of got it up to a good space, brought in another partner to, manage the accounting side. And then, I've been focusing a lot more on the pure finance space.
So cool.
We'll have to get you on for the mortgage broking hat that you wear on another episode, I think.
So yeah, that's where we're at now. So it was a bit of a wild ride, but definitely don't regret anything that happened.
Yeah. So is there more numbers in finance broking?
No, it's even less again. Yeah, that's it. Yeah, being a people person, and then understanding a lot of that. I'd say financing, more the investment space is where the numbers come in if you're going into analysis and whatnot. But no, nothing in what I thought. And whenever I chat to people, everyone just thinks if you're an accountant, you're good with numbers or you've got a calculator in your head. But that couldn't be further from the truth.
Just a boss at keeping up with legislation.
Yeah, that's it. Yeah, constant CPD.
Yeah,
all the time.
Love it. And Sam, do you have any questions for Andy finishing up at all?
No, I think we've touched on a few key points, and obviously really grateful for his time, and I'd say there's definitely more to delve into. And if people do have any questions, obviously please leave some comments below. If you like Andy, if you don't, I'd like to hear that as well. But there's definitely a number of questions out where you take that accounting hat off and you put onto your mortgage broking hat, which would really benefit the community. But once again, we're just mindful of your time, and thanks very much.
Yeah, thanks.
No, thanks for having me. It's been good. Look forward to coming back.
Yeah, well, we're definitely just scratching the surface.
Yeah. No.
Next time we'll chat more.
The knowledge carrot of Andy Giobi. So where can we find you, Andy?
Yeah, so on the mortgage broking side of things, so Binary Finance is my company. So you can just go to our website on Binary FG, so F for Fred, G for goat.com.au. So binaryfg.com.au.
We'll put links to that show notes as well. And guys, if you want a personal intro to Andy, just let us know. hello@propertypals.au, and we'll do an intro. We'll probably talk about some of the people that you've helped with finance and some of those stories next
Yeah, well, I've got plenty of stories even around stuff we've chatted about today. A lot of things that one small rule just completely changes the structure and the path that you go down.
Love it. All right, everybody, thanks for listening, and we'll chat to you soon.